Hi guys, how are you and how is your trading account? Hope your equity curve is still bullish. Welcome to today's video. If this is your first time here, special welcome to you. On this channel, we approach the financial market with facts and institutional data. This enables us to see the market in the same perspective as an institutional trader. You can join the Tom's Capital family right now by clicking the subscribe button and turning on post notifications so you'll be one of the first set of people to see our videos when we drop them. In today's video, I'll be sharing with you the 7 elements that make up a good trading plan. So if your system is missing any of these 7, you need to include it as soon as you can. Without wasting much of our time, let's jump right into the video. At the very top of the list is direction analysis. Knowing the direction the market movement will be is the most important duty of a trade analyst. If you apply the best entry analysis in the wrong direction, you will definitely be shocked by how price will easily violate your zones and levels. There are many ways traders determine direction of the market. Some of these ways include simple moving averages on the daily chart. Adding 2 EMAs, maybe 12 and 36 on the daily chart, can be a very simple and relatively efficient way to determine market direction, such that when the 12 EMA is above the 36 EMA, you have a bullish bias, and when the 12 EMA is below the 36 EMA, the direction is bearish. Let's see what this looks like on the chart. Here we have the Euro USD daily chart. Let's go ahead and add the indicators. That's the exponential moving averages. EMA, we are adding 2 for 1, 2. Now let's adjust the settings. The first one is going to be 12. And let's make that green. The second one will be 36. So we have EMA 12 and EMA 36. From what we have on the screen, the green EMA is below the blue one, which means the EMA 12 is below the EMA 36, and that means downwards trend. And from what we can see right here, you see the market has been in a very bearish trend, and see right here the trend changed. We had the green one above the blue one right here, and at that point we can see the market entered a range and we had a bullish move right here. At this point, the 12 EMA is back below the 36 EMA, which means we are back in the downtrend, and as you can see it, price kept going downwards. See the downward push right there, and the green EMA remained below the blue one, which means the downtrend continued. As you can see right here, the downtrend really continued. So this is one of the methods to determine the direction of the market. Another method of finding market direction is liquidity pool on a high time frame, like the daily and the 4-hour time frame. The market always moves from one liquidity zone to another. So if you can spot the liquidity zones, then you can predetermine the market direction in the nearest future. If you don't know how to spot liquidity pools on the chart, then you need to watch our previous video on liquidity and liquidity pools. Using the chart on the screen, let's find an example. Right here on the screen, we see a liquidity pool right here, which is what we want to use to determine our direction. At this low, we have, let me mark that clearly. At this low, we have this ABCD swing to the upside, which makes this a liquidity pool. So I'm going to mark that with a $sign. Good. And after that, we also have another ABCD swing from this point. Let me mark that also. We have ABC swing right here, which makes this another liquidity zone. That means we have this zone, the whole of this area, as a liquidity pool. That means the market will come down into this zone to clear the liquidity, which automatically tells us the market's direction will be bearish in the nearest future. Let's see what happened. As expected, price dropped into the zone right here. There are many other ways to do direction analysis in the market. Personally, I use institutional accumulation and distribution in addition to macroeconomics, which we popularly refer to as fundamentals. This is a whole course on its own and it's very difficult to come by, especially on free platforms like YouTube. The second element of a professional trading plan is structure or range analysis. Many traders don't have this in their system, and that explains why the market suddenly reverses on them while in a trade. The structure or range analysis helps you to determine where the movement in the direction you determined in the first element is headed. This, in a simpler term, is target analysis. In a market that have been determined to be bearish, you need to know how far the bearish move will go before reversal or major retracement. There are many ways to do this. In the case of liquidity pool method of determining direction, the range of movement or the target is predetermined and it is the liquidity pool. However, for other methods of determining direction, you need to find a way to determine how far the move will go. One of the simplest and most common range or structure analysis is the Fibonacci extension. This is based on the ABCD swing price pattern, where the C is the retracement and the D is the Fibonacci extension target. The most commonly used extension is the 1.618 extension. As shown in the illustration, if price is to be bullish from this point right here, the Fibonacci extension tool can be used based on this range to project where the target will be, which is commonly the 1.618 extension. The 1.618 extension is not always fulfilled. This is because the Fibonacci extension to be targeted is dependent on the depth of the retracement leading to the extension swing. Other methods used to determine targets are swing highs, swing lows, price action, demand and supply. We also have symmetrical extension as shown in this illustration, whereas the A to B movement is equal to the C to D movement. This is what is commonly referred to as measured move. Here at Tom's Capital, we use EBITDA major prices for our range and target. If you don't know what EBITDA major prices are, that means you haven't seen our video on EBITDA prices or you didn't watch the video to the end. If that is your case, you need to go back to the video, watch it again to understand the concept and how it's applied. The third element of a professional trading plan is timing. This is a very important one because entering a good trade at the wrong time can be detrimental to the trader in two ways. The first way is that price may remain around the entry for a long time, which can test your patience as a trader. If you are not patient enough, you end up closing the trade at break even, thinking the market won't move in your favor, but almost immediately after you close the trade, the market will speed off in your original direction. I'm sure we've all experienced this. It makes you feel like you are being watched by the market maker. The truth is that no one is watching you, you just happen to have entered your trade too early. The second way this can hurt the trader is that price can hit your stop loss level before moving in the intended direction. This is because most times when reversal patterns happen before the right time, it is often a liquidity inducement by the market makers to lure retail traders in before time so that they can run them as liquidity to pair their additional orders. Some of the best times to execute a trade are session opens, that is London Open and New York Open, session overlaps, high impact economic data release time, and we have contract opening and closing days for position trades. The fourth element of a professional trading plan is pricing. Apart from knowing the best time to trade, there is also a need to know the best price to trade. Professional traders trade at specific prices, unlike retail traders that can open a trade at any price. All they care about is the pattern. Some of the best prices to trade are round figure prices, commonly referred to as psychological levels, price like 1.1100, 1.1200 and so on. Personally, I use the minor EBITDA prices for my trade execution. I discussed this in our EBITDA video. If you haven't seen the video, take time to watch it right after this one. The fifth element of a professional trading plan is the entry pattern. Most retail traders are professionals on this because it is what they refer to as trading strategy. Entry or reversal patterns can be indicator based, price action based, smart money concept based, or whatever reversal patterns you know. Anyone will work as long as you have the first 4 steps in check. For me, I have 5 ultimate reversal patterns that I use on all my trades. I have made a video about the 5 patterns and it's on this channel. If you would like to know the reversal pattern, go ahead and watch the reversal pattern video right after this one. The sixth element of a good trading plan is trade management. It is not enough to open a trade. To achieve the best results, you will need to properly manage that trade. Under trade management, you determine the number of positions you want per trade. You determine where you want all your stop losses and take profit levels to be, when to move your stop loss to break even, or whether or not to move your stop loss till your final take profit is hit. The way you manage your trade is totally up to you. It will depend on how well you can handle risk exposure, how well you can hold on to a trade to let it run. I have a friend who is a very good trader but cannot leave risk on a trade for more than 2 hours. With this kind of personality, his trade management had to be designed to fit him. Let me explain how he manages his trade so that you understand what I'm talking about. What he does is he opens 2 positions per trade. The take profit of the first position is at 1-to-1 risk reward, which must be achieved in 2 hours or less. He sets the second take profit at the final target. Immediately his first take profit gets hit, he moves the stop loss of the second position to break even, and that makes the trade risk free. At this point, he leaves the second position to run for as long as it takes to reach target. He is very good at holding trades, but he just don't want to hold them with risk on. This sounds like a very good approach, but it has its advantages and disadvantages. The major advantage is that risk is taken off very quickly, which means it will avoid many losses. But the major disadvantage on the other hand is that after moving to break even at 1-to-1 risk reward ratio, the market can retrace back to take out its stop loss at break even before heading to the target. He knows this, but he doesn't care because that is the trade management system that suits his personality. I know you all will like to know how I manage my trades. What I do is I open 3 positions per trade. These 3 positions does not mean I increase my risk. The same risk I would have taken on a single position is what I divide into 3. I set my first take profit at 1-to-3 risk reward ratio or at the targeted liquidity pool. The second take profit level I set at the next major EBITDA price, and the third position I don't have a take profit for that. I trail it using the minor EBITDA prices until I get stopped out or I get an opposing setup. That is the trade management system that suits my personality. So you have to know yourself first before creating a trade management system. The seventh and the last element, which also happens to be the most important element of all, is money management. As traders, our primary job is risk management. The first mission is to make sure you don't lose more than you can afford to lose. So protecting the capital is our priority. If you are able to protect your capital, the profit will definitely come. Under money management, you determine how many percentage of your account you want to risk per trade, how many you want to risk per day, per week, and per month. The general rule of thumb is 1% per trade and 10% per month. There is a general saying that 90% of traders lose 90% of their account within the first 90 days of opening the account. This is practically impossible if you follow the 1% per trade, 10% per month rule, because it will take you more than 9 months to lose 90% of your account. The more you lose, the lower your monetary risk becomes. This means even if you lose all your trades, you have about 11 months to blow the account. That's almost 1 year. That automatically moves you from the 90% majority to the 10% minority class of traders. Personally, I risk 0.75% per trade and 12% per month. This is very easy for me to follow because I trade only two pairs, which is Euro US dollar and Pound US dollar on my active trading account. Also, my setups are based on intra-week contracts, which limits my trade to 2 setups per pair every week. That is 4 maximum possible setups per week and 16 maximum per month. 16 trades at 0.75% is 12% for all my trades in the month. That is if I get a setup for every intra-week contract in that month, which is definitely not likely to happen. This means I can only lose 12% in a month if I lose all the 16 trades of the month, which is absolutely impossible with the way I trade. I only take intraday trades inside a profitable intra-week contract trades that's already risk-free. This money management really works because numbers don't lie. If you follow it to the letter, then it will definitely work for you. Try to implement these 7 elements in your trading and see how you will drastically move up the profitability ladder. If you got value from this video, give it a thumbs up right now. If you are yet to subscribe to the channel, do it right now. Smash the subscribe button and turn on the bell icon. If you have any questions, leave it in the comment section or message me privately on Instagram at ThompsCapital. I'll try to answer as many people as I can. I'll see you on the next video. Have a good day and happy trading.